What if your accountant looked you dead in the eyes and said you legally owe less than half of what you paid last year? Would you believe them? Or would you assume something shady was going on? Last year, I cut my tax bill by over 40%, and I did it without an offshore account, without a shady shell company, and without a single thing I'd be embarrassed to explain at a dinner party. The catalyst wasn't some genius move, it was finally getting serious about structure. Specifically, how my income was classified, how my assets were held, and whether my business entity was actually working for me or against me. Most people are overpaying not because the tax code is unfair, but because they've never been introduced to the parts of it designed for people who own things. Think of the tax code like an iceberg. Everyone sees the part above the water, the W-2, the standard deduction, maybe a Roth contribution. But underneath, there's a whole universe built for business owners, real estate investors, and the self-employed. The moment you move from employee to owner, the rules of the game change dramatically. And most people just never get the memo. The optimism hit me hard in year one of owning my business. I thought, great, I'll write off my laptop and call it a day. Then April rolled around and I handed over a check that made me physically nauseous. And I thought, there has to be a better way. Here's the psychological trap that keeps people stuck. They assume that aggressive tax strategy is only for the ultra wealthy, so they never ask the questions that could actually save them thousands. Experts like Tom Wheelwright, who wrote the book literally called Tax-Free Wealth, have been screaming for years that the tax code is a series of incentives, not punishments, but most of us were never taught to read it that way. Historically, every time the tax code gets updated, there's a short window where informed people capture enormous advantages, while everyone else complains about the new rules on social media. The 1986 Tax Reform Act, the 2017 Tax Cuts and Jobs Act, both created massive opportunity for those paying attention and massive confusion for those who weren't. Here's the cycle you need to understand. Tax strategy follows asset ownership, and asset ownership follows knowledge, and knowledge follows who you're willing to learn from. Online communities of real estate investors and small business owners have been sharing these setups openly for years, and the consensus is consistent. Entity structure, depreciation, and retirement accounts are the three levers that move the needle most. The biggest misconception is that reducing your taxes means triggering an audit in reality. The IRS audits fewer than 1% of individual returns, and the strategies we're talking about are explicitly written into the code as incentives. You're not hiding income. You're redirecting it through structures the government literally created to encourage investment and job creation. So what actually moved the needle for me? Three things. Electing S-Corp status on my LLC, which reduced my self-employment tax exposure significantly. Maxing a SEP IRA, which pulled tens of thousands of dollars out of my taxable income entirely. And using cost segregation on a rental property to accelerate depreciation and create a paper loss that offset real gains. None of this required a team of lawyers. It required one good CPA who specializes in small business and real estate. The practical lesson from every high earner who figured this out late is the same: start the conversation in January, not April, because tax strategy is built throughout the year, not filed at the end of it. Position size matters here too. Don't over-leverage a strategy just because it worked once. And don't ignore a tool just because it sounds complicated. The discipline isn't in finding the most aggressive write-off. It's in consistently applying a system year over year, letting the compounding effect of retained capital do its work quietly. One great tax year is nice. A decade of structured, intentional tax planning is how wealth actually accumulates. There's something almost poetic about the fact that the same government people complain about also wrote thousands of pages of code specifically designed to reward you for investing, hiring, building, and creating. You just have to show up with the right setup. Whether tax rates go up or down in the next administration, the principle remains: own things, structure properly, and let the incentives work in your favor. And if you're ready to take the first step, whether that means investing in real estate, tackling a renovation project, or finding the right lender to make it happen, check out our links in the description below, and let's get you started.